Guava said, hi, I'm a blueprint buyer. I recently bought a collar. So we mentioned the collar. Hey, on that Yeti position, I would have bought that stock at 35.71. We didn't show it on the graph yet, but we might take a look at that. But I would have bought the stock at 35.71. I would have sold the September 37.5 call and likely bought the September 30 put out of the money. It creates that long collar position. I have a capped upside, but I give myself some wiggle room, and I have a limited downside, but it's only for 30 days. So low risk trade. We took away from some of the potential return of the out of the money covered call by buying the put option at the lower strike. So we have a controlled risk and a capped gain. This is a long-term long collar. You bought coin 322.93 earlier in the week, or I think it was Friday, actually, sometime Friday. Bought the 340 put for June expiration, now about 100 days out in time at 72.80. That's probably what I would have done with a married put, maybe gone with a 350 strike for June. But then immediately sold the 380 call for June expiration, 105 days out in time at 53.37. Now he says, based on my calculation, cost base is 34,236. The max loss is only 236, and the max profit is 3,764. So the reward risk ratio, he says it differently, and that threw me off, or she, I'm not sure. They said it differently. I always say risk reward. They said reward to risk is 16. Is it too good to be true? Any comments on this setup? Thanks. Now, I did answer Guava and discussed briefly some of the other concepts we might approach based on their expectation of coin going forward. But now let's navigate back over. Let's go to power options. And we're going to go to the portfolio tool real quick. I entered this coin position into the trade so we could take a look at it before we discussed other options. Because options give us options. Here we are with the suggested trade, or mentioned trade, Coinbase. 32,293, 100 shares at the 32.93 purchase price. June 380 call. All right, so we're a good range out of the money. We're 57 or so dollars out of the money, 57.07 out of the money. We collected 53.37 in premium, and we bought the 340 put in the money from the stock, about $18, $17. So we're above the current stock price. We're paying for the time, 300 days, just like we got 53.37 for this out of the money call. We're paying some intrinsic value here, as I mentioned, that $18 or so, $17 or so, but the 72.80, the rest of that sort of $57 we're paying for this is the time value for the slightly in the money put. The original expected return is 11% on the position if coin is above 380, and the maximum risk on the trade was only about, the 236 there, I'm sorry, which was a very small number. It was less than 1%, 0.7%. That is, I apologize, folks, if assigned, we'd make that profit of 37.64. The most we can lose is 236. It is a reward to risk ratio of 16. What's wrong with this trade? Nothing's wrong with this trade. But what are your goals, your risk tolerance, and expectations? Nothing is wrong with a risk of 0.7% in 100 days, 300 days. I'm sorry, I said 100. It was 300 days. I apologize. In any case, 300 days. And nothing's wrong with 11% return in 300 days, under a year, so an annualized return of 13.4%. But just like the discussion we had in the monthly covered call positions, this is far out in time. Clearly, this setup is speculative bullish. It's an interesting comment, isn't it? It's speculative bullish for coin because we want the stock to be above 380 in 300 days. Not saying that's not impossible. I'm not bearish saying that coin is going to crash back down to $115 or anything like that. And if so, hey, you only took a risk of 0.7%. But this 16 factor we're talking about here on the risk reward in this case, making 11% but only risking 7% comes with what? When I looked it up on the option chain at the time, the probability, even 300 days out in time, that coin would be above 380 and we'd make the 11% return was only 27%. All right. The probability that coin 319.85 would be below 340 in the next 300 days was roughly about 71%, if I'm not mistaken. I think it's probably changed now with the movement of the site. It went way down, as you know, and then it's come back up to 1957, moved up 1957 today. So it went almost below 300 with this purchase price of 322. But this was at about a 71% chance. So, okay, 71% of the time I lose 0.7%, and 27% of the time I make 11%. Okay, is that a win-loss ratio that we can take? Well, I don't know. But let's talk about some of the other win-loss ratios we've discussed. And let's see, 11%. I'm sorry, I'm just writing down these notes here. Is 27 and 0.7 is 71. Okay. Now we talked about our covered calls. Now it's not the same stock, but let's just take a look at the chain on coin, shorter term. And I'm sorry, I just want to go to the option chain. I just want to be in the call chain. But we're going to go 1 month out in time, even though we have weeklies. We're going to go 1 month out in time, folks. And I'm sorry, I want to be just in the call chain to be more clear. And let me get a good one here. Let's get at least a 10%. There it is. Okay. Today, coin at the 297.50 strike for September, we're getting a 10% even downside protection. You could buy the stock at roughly 320, sell the 297.50 for 32.28. So yes, we're about, what is that, 22.50 in the money, but we're getting 32.05, 32.08. So our time value percent, getting a good time value of 3%. That's our percent return if assigned, 3.4% at midpoint, with a 10% downside protection and a 68% probability. ITM covered call. 10% downside protection here for a month, mind you, 10% protection, 3.4% return with a 68.5% probability of getting that 3.4%. Now let's do the opposite very quickly. 68.5% would translate to what? 31.5% probability. Not quite there, and the numbers aren't exactly reversed, but this one is pretty close. Instead of a 3.4% return, the 340 strike, hey, the put, Guava bought, the out-of-the-money covered call at 11.58, midpoint. Buying the stock where we are now, 319.85, let's just call it 320, getting 11.58 for the call. It's 20 points out of the money. Gives us only a 3.6% downside protection. A 10.3% return if assigned, but only a 34, let's just call it 34.5, round it up, 34.5% probability of making that 10.3% return. And why am I going through this? Again, simply because talking about, is that a win-loss ratio long-term? Well, we've got a tool for you that does it. If you go to our other website, radioactivetrading.com, this is focused mainly on the married put approach, the radioactive trading techniques, and the 13 different income methods. And Guava mentioned he is a blueprint owner. They mentioned they're a blueprint owner again. So they're doing different things. What's wrong with this trade? What's wrong with opening the married put as I would over the coin, but selling that 300-day out call right away and having this really low risk of 0.7%? And still making about 11% in 300 days. On radioactivetrading.com, you can click on the Resources tab. And inside the Resources tab, you can link to the 2-week free trial at Power Options. We want to go to the Trade Simulator tool. This is a simple tool, but can be very powerful, this kind of analysis we're talking about. What this tool does is you can put in your expected target return for a strategy. Hey, whether I'm doing credit spreads, simple covered calls, my approach for married puts, Ernie's approach for married puts, we're going to put in our expected gain. So what do I mean by expected gain? Hey, we talked about if I'm opening those in the money covered calls 30 days out in time, I'm looking for that 1.5, maybe 1.7% return with a 12, 15, 20% downside protection perhaps, with that 80% probability, 75% probability of getting that return. In the case of Guava's position, only had a 0.7% risk with an 11% return, but only a 27% theoretical probability of making that 11% return. And we talked about our out of the money covered calls. Hey, consistently, I'm only taking getting 3.7, 3.5% downside protection with the potential to make 10.4, 10.5%, but that's only a 35% probability. This tool helps you show what your expectations are. Even with the low probability, because of the controlled loss limit, I think over time, Guava's is going to be the best. But let's take a look. What was our target return? That coin, long collar, out of the money, it was an 11% return, roughly. 2,764, 3,764, I believe. 11% return. A loss limit of only 0.7%. Less than 1%. Now, the probability of loss, we got to think differently on this one. There was only a 27% chance, theoretical probability, that the coin position would be above 380 in 300 days, and we'd make the 11%. That 27% probability above translates, of course, to a 73% probability of loss. I'm expecting to be wrong 73% of the time. I'm going to take $10,000, and I'm going to open 2 trades each cycle. Now, this is a bit, we'll have to talk about that too, because it's going to be skewed, because if we're doing 300-day out long collars in that structure, it's going to take us a lot longer to get to 100 trades. But what this is going to do, it's going to flip a coin. Heads, we make 11%. Tails, we lose 1%. And we're going to be wrong about 73% of the time. Are we going to have a winning track record after 100 trades? And it's not 50-50, 73. But it's random. You're going to have strings of winners and strings of losers flipping the coin. So let's run that. Not too bad. After 100 trades, we take the account up to 29,438. Great return. We only saw a drawdown of about 1%. That makes sense, doesn't it? And we are dead on, 73 to 27. We have a bad market. Oh, shoot, that refreshed too much. We have a bad market. We still make out ahead. We only wrong 80% of the time. We make 20% of the wins. Had a drawdown of about 6.5%, and we're still doing gangbusters. With strings, as you can see, strings of losses in a row. That's what's expected with this probability. But to be fair, I don't know if I'm going to get back to that first one, but 73, 70 to 30, we're still doing well. Okay, and we expected that. Not all positions are going to offer that risk reward that we saw with coin. Now, here's one with the same values. I'm going to keep this one, actually. Okay? Had a 5% drawdown over time, over 100 trades. But remember, these are much further out in time. And only 27 wins, which we expected, 73 losses. And we took 10,000 up to 27,849. Okay. Now, in the money covered call, I'm going to make 3.4% when I'm right. I'm going to have a downside protection of 10%. So even in the case if the stock falls 12, 14, or 15%, probably only going to be loss limit of maybe 2 to 3%. Let's go with 2.5, right? Because we're getting that 10% downside protection. And the probability that we make this 3.4% was 68.5. That's going to translate out to 31.5% probability of loss. I don't think this is going to do as well because that loss limit was so controlled at 0.7%. That's the most important factor, believe it or not. It's not getting better winners, it's controlling losses. but controlling losses without changing the probability of success. Here's one that's almost spot on, 69 to 31. These were the in-the-money covered calls. I used a loss limit of 2.5% because we were looking at a downside protection of 10%, and in 30 days, a stock falling 12, 15%, unless something catastrophic happens. We go through a bad earnings, but I usually avoid in-the-money covered calls on stocks I'm looking for this return for with earnings between now and expiration. Okay. And what we saw here with coin, with these numbers, if it didn't drop more than 15%, the loss would have only been 2.5% or so. With our 10% downside protection, 32% didn't make as much to the upside, only made 20,952 compared to, or 51, compared to 27,849 with the coin out of the money position, and the drawdown was equal. Now, reverse it. I'm expecting to make 10%. No, it was 11, wasn't it? Out of the money covered call, 11.5% if assigned for coin. We were looking at that 340 call for September. Gave us a potential 11.5% return. Our downside protection was only 3.6%. It's almost the reverse of what we saw with the in-the-money covered call for return versus protection. So if the if the stock fell 10, 12, or 15%, we're going to be down 6, 8, maybe 10%. Let's put the loss limit at 7. Kind of using the William O'Neill idea, from IBDA. If you're in a covered call and the stock falls 7%, you're in a stock and it falls 7%, just exit because you can't risk taking a 10, 15, or 20% loss because it takes too much longer to get back to break even. So we're going to say we're going to take 11.5% return. Let's keep it even. Let's say loss of 7.5% on the trade. But remember, we're reversed. The probability of making that 11.5% was only 34.5%. So our probability of loss, it's going to go up to 65.5%. Now, I know the number just changed there for the starting amount. I'm going to take care of that. We're going to go back up to 10,000. And we're going to keep the 50% invested in the trade. Flip the coin 100 times. Heads were right, we make 11.5%. Tails were wrong, we lose 7.5%. But we're only expecting to be right 34.5% of the time. So we have a 65% times we're going to lose 7.5%. Do we win at all? Not really. Here's 37 and 63. Let's get that up. We did have a winning record at one point. 34.66. Close, right? Let's hold that. I'm going to do another one though. So we eventually made 5%. We had a drawdown of almost 56%. I want to do that again. Same thing. Almost an 11% return, what we were looking for at one time. We had a string of winners in a row when we were up to 11,631. Very close to it right there at 11.26 trades in. Hey, we're making 11%. Started with 10,000. We're 11,452. Some losses, some backup. Wow, we're going way down here. I need some winners. 11,631. There it is. 65th trade in. Doing 2 trades per month. That'll take me 30 months to get to this point. And then I got some strings of, bad mojo here. There's where we're down. Not even to the worst yet. That was earlier. Oh, no, it's right here, 96. So once you're at that point, naturally it's going to take you much longer to get back to break even. What is this simulating? Out of the money covered calls. Higher return, lower downside protection. At one point, we're half of what we saw with the other 2 approaches, the in the money covered call, and even this collar that Guava mentioned, this low risk, because the risk was so controlled that even though he was taking 73 losses, it would still balance out over time. That's not bad. But it's going to take what? With that long-term approach, it's going to take a lot longer to get to 100 trades. The in-the-money covered call was 20,954, 7,000 less than what we saw in the other one, but with the same drawdown. This is where you've been running into problems with the covered call. And again, it's not necessarily the trade. It's the comparison of, I want to be selling out of the money because I'm expecting a higher return, I'm expecting growth, or I want to hold on to the position long term. But over time, when you have bad months, yes, you're going to be managing. I understand that. A comment comes in where you can always roll. Yeah, but if you chase the stock down too far, we talked about that a few moments ago. Oh, actually, with me, it was probably like 15 minutes ago. But when the stock keeps falling down, you keep rolling down and rolling down. The stock's falling more than you're getting for the premium. Your cost basis is falling slightly. You know, on the coin position, we talked about buying the stock at 322.93. It was almost at 300. I keep rolling down. I rolled down to the 310 strike, but you know, I paid 320 for it. I'm probably only getting $5 or $6 in the shorter term, weekly or monthly. And so I've only probably cut it down to 318, maybe even 315. But now I'm selling the 310 or I'm selling the 305 call, the stock down to 300, and then suddenly jumps up 19 points today. Now I'm being assigned for a loss. I've got to roll that back. I'm paying $18, $19, $20 to buy back that 300, 305, 310 call and got to move it back up. Now I got to move out further out in time too to try to roll for a credit to keep my cost basis going down. And then it falls again. You chase it back down. Oh, it comes back up again. And that's the flaw of the structure of the trade. We've capped our upside and left the downside open.